next to the next. The most common qualified retirement plans that you guys will come into contact with is either a 401k or a 403b. Right off the bat, the easiest way in the world to remember this is they're typically the same exact type of plan regarding how it's taxed, how you could have a certain employer match. The main difference is 401k is for private, 403b is for public. What exactly does it mean to be a qualified retirement plan? What is it qualified from? Whenever you're dealing with these employer benefit packages, understand the word qualified just means qualified through the IRS. It's monitored for tax purposes. How exactly can, and in 1974 they came out with a branch of the government called ERISA. It was a way that the employee could actually take his own risk for retirement and not actually give it to the company. So he could choose his funds, and a way for that to become attainable was the IRS said, all right, as long as you're doing this, we're gonna have a qualified, we're gonna have a monitored retirement plan as well. So we could give you some incentives to either invest into this plan, you get some tax deductions, but ultimately, we wanna get our taxes somehow. We need to somehow fund our taxes. So this is qualified through the IRS. Pre-tax. You're going to hear this word a lot, pre-tax. All that means is that you receive a tax deduction for all your contributions in towards these plans. What is exactly a tax deduction? A tax deduction is if you're making $100,000 a year for hypothetical purposes and you throw $5,000, 5% into your retirement plans, your qualified retirement plans. At the end of the year, when you're doing your statements with your accountant, with the IRS, it's as if you made $95,000. You're taxed at the $95,000 income tax bracket, not the $100,000. So you're getting a tax deduction that's lowering, and it can actually lower you into a different tax bracket depending upon how much you make, and you could actually leverage it that way. But ultimately, just understand you're receiving the tax deduction now, and the IRS isn't that generous. So you're going to receive the tax deduction now to pay taxes later on. What exactly are these plans? What do you typically see within your employer plans? Your money that you're placing into retirement, your company is giving you options. Now these options are typically, I'd say 99% of the time, it's through some sort of mutual fund. When you're looking through your employer plans, you're going to be seeing something might say aggressive, something might say moderate, something might say conservative, something might say fixed. And then you can have different nuances of those words. You might have aggressive moderate, moderate conservative, and you typically just have a fixed account in there as well. When I say mutual funds, mutual fund is a conglomeration, it's a mixture of stocks and bonds. Whenever you do some sort of investments, or you're reading up on what's the difference between a stock and a bond, a stock is you're betting on the company is going to become profitable. A bond is that you're betting the company is not going to go out of business, kind of like a company would invest in your education for your student loans. You're acting as the student loan company because they understand that they're eventually going to get their money back plus interest. You're going to loan a company money because as long as that company doesn't go under and they could at least pay you back, they're going to pay you back whatever money you've given to that company plus interest. So it's a mixture of stocks and bonds. When you have aggressive, it's about 80% stocks, 20% bonds, moderate 60% stocks, 40% bonds, conservative 30% stocks, 70% bonds, and a fixed account. You typically see people saying, the market's so crazy right now, I don't even understand it, let me just throw all my money in a fixed account. Your fixed account rates right now are paying maybe 1%. It's pretty bad out there right now. But in a typical scenario, you're gonna see about 5 to 15 different fund options, different fund choices. So you want to correlate it based upon your risk tolerance. If you're understanding that you have decent funds in there, or you're understanding, okay, I'm a little bit younger now, I want to be a little bit more aggressive because typically the stock market's going to be increasing, I'll go a little bit more aggressive. Then obviously as you teeter down the path towards retirement, you're going to go from aggressive to moderate, moderate to conservative, so that you're having more fixed assets, and then eventually into the fixed realm where it doesn't matter. You're not going to be subject to market loss because your money will typically be in some sort of fixed accounts. They typically only have about 5 to 15 different funds with those. So if you were to do individual retirement accounts, Roth IRAs, different things like that, you might have 300 different funding options. So the employer says, okay, well, we're going to give you access to this plan, but the downside might be that they have limited funds. There's a 59.5 rule. Once again, this is a qualified plan through the IRS. So the IRS is eventually going to say, okay, you're receiving your tax deduction. We're going to basically stick you between a rock and a hard place when it comes to taxes. A 59.5 rule means that you cannot touch this money until age 59.5. If it's a qualified plan, you cannot touch the money until age 59.5. Or you would receive a 10% penalty plus whatever your income tax bracket is. So if you're working, you're accumulating money, and you had an oh my gosh moment, and you said, okay, either I lost my job or something happened, I need to pull money out of my 401k. Let's say you're age 52. If you want to pull out $100,000 for a hypothetical situation, and let's say you're at the 30% tax bracket, the IRS is going to penalize you 10% for taking it before 59.5 plus your 30% tax bracket, meaning 40% of your money, $40,000, will have to go to the IRS, and you only get to keep 60. That's a very, very tough pill for people to swallow. They do not like it, so that's why if you're accumulating into qualified plans, don't just accumulate all your money into qualified plans. You have to understand where certain allocations measure up, why to have some money in liquid cash into stocks, individual mutual funds, and whether to have it in the actual retirement plans itself, because these plans are ultimately geared for retirement. You're not supposed to be touching it before retirement. You have something called a 70.5 RMD rule. This is the rock and the hard place. You cannot touch the money before 59.5, and you have to start touching it by 70.5. You need to start taking some sort of distributions. Why is that? The IRS needs their money. You were getting tax deductions, meaning whatever you were contributing in towards it, tax deduction, tax deduction, tax deduction. It was accumulating, and now the IRS needs their money. So you can't just hold on to it and say, oh, whatever, I'll just hold on to it forever. At age 70.5, they require that you have to take some sort of minimum distribution by age 70.5. So let's say you're 71, it might be 2.5% of your account. 72, it might be 3.2%. And it's going to tick up and up and up every single year that you're living. Like we've mentioned before, the IRS needs their money. This is a qualified retirement plan. Qualified meaning it's monitored plan for tax purposes for the IRS. So this is going to be fully taxable at your tax bracket. Your tax bracket, and you could look up charts online. We could provide you with charts. Ultimately, it means how much money you have received that year. If you are receiving, say if you make $50,000 and you start your retirement distribution and you're making an additional $40,000 you're taking it from distributions for retirement, instead of the $50,000 that you say, okay, well that's what I'm working, that's what I'm making, because you're also adding $40,000, you have $90,000. You look at the tax bracket, how much money did I make for this year technically on paper, and they don't only show you what your income was, but also what you took out of your retirement plan. So you could be taxed at the $90,000 tax bracket. And they have different charts. They have ones for 72,000 and to 35,000 is one, 72,000 to 116,000 is another. It all depends upon every year. It changes, and the percentages change, which is huge right now for some of the younger generation, because back with the baby boomer generation, tax brackets were at all-time highs. So they get their tax deduction, and then they pay taxes now when tax brackets are all-time lows. Unfortunately, with what we've been seeing going on with the economy, is we're constantly borrowing, we're constantly spending, we're constantly owing, we have all this debt that's accumulating. So how exactly are they going to be able to pay those taxes back? How exactly are they going to be able to pay that money back? They're going to have to raise taxes. This is one of the tips for nurses in particular, because nurses are one of the occupations, as nurses, nurse practitioners, CRNAs, You guys are constantly moving around, you're constantly changing your employers, and you have to understand exactly what it is that you have. If you have a 401k, it's most likely a private institution, meaning it's owned by a private company, and a 403b is a public institution, meaning that's owned by some sort of state entity or some sort of public entity. Once again, my name is Derek Afasi. Please navigate throughout the other videos, and I thank you for watching this video.